welcome back to the channel, your number one source for income-oriented investing. It's time to go over the high-yield, income-oriented landscape on the Canadian market. So, of course, we're going to check out real quick what the markets have been doing in the last month. We'll start with the Canadian market, the S&P TSX Capped Composite Index. If we look at the 1 month performance, it's basically doing really well, up 4.85%. By the way, the market is live while I'm filming this on October the 7th. So where's the market crash? Where's the recession that's coming? Well, I guess people got bamboozled once again. Like and subscribe. Thank you very much. Next, we move on to the overall American stock market. So what better index to track than the S&P 500 in the last month, also doing well, up 4.71%. Again, this is live, that's why it's changing right now. So both markets, Canadian and US, done particularly well, especially the Canadian market. You see it has a little edge, and that's because cyclical sectors are starting to come up, starting to pop. Energy is going up. That also helped. Obviously, it helps Canada a lot, which is very energy focused, very financials focused as well. Typically, when rates go down, interest rate goes down. When there's conflicts in the world, oil prices go up. Gold has been doing well as well. So this is obviously helps the Canadian stock market a lot. So let's go through the income landscape, everyone. Let's go through the funds which I feel are diversified, that you could buy and hold forever pretty much. Leverage, non-leverage, will I always like to focus on those, and then at the end of the video I'll discuss some sectors that I feel maybe are undervalued. Very hard in a record high market, but we'll see what we could find. So first of all, I'd like to thank the sponsor and good friend, longtime good friend of the channel, Harvest ETFs, who are in the middle of a little rebranding here. You can see that their logo is different. So I'd like to thank Harvest for sponsoring this series, being a good friend of the channel. They have HDIF, which is their all-in-one equity solution, right? This has a collection of Harvest's covered call ETFs with 25% leverage. They also have HBIE if you want kind of the same thing, but you want a 60-40, 60 stocks or equity and 40% fixed income mix. They also have recently launched their high income shares. So this is covered calls on a single company. You have Eli Lilly, Amazon, Microsoft, Nvidia for now. Very, very interesting. They have leveraged and a non-leveraged versions as well. I pretty much own all the leveraged ones now. I have a little bit in each of them. I think they're really, really fun and really boost the overall yield of your portfolio. And they also have Happy T or HPYT, which is very popular, past 500 million in assets. This is the highest yielding US government bond ETF in Canada with over 16% yield. And I believe they just passed their 1 year anniversary for that. So again, thank you to Harvest. And of course, HDIF, as you all know, is definitely one that we always going to check out every single month. No distribution changes from the last month. You guys know that they've increased their distribution starting with the with the August payment. You see that little increase here. Same thing for HBIE, by the way. So I know I talk about HDIF a lot, not HBIE, but HBIE also. Oh, actually, no, sorry. They did not increase their distribution. It's still a very consistent 20 cents a month. Apologies for that. I thought they did. It's the unleveraged version of HDIF that did. That's what I was thinking about, HRIF. All right, moving on. We got Hamilton, of course, with their two all-in-one, H-Yield and HDIF. H-Yield is the American-focused one. HDIF a little bit more Canadian, a lot more Canadian-focused, but there's some U.S. in here as well. No changes as well here, guys. There's nothing. There's the same 14.3 cents as last month. Last couple of months, HDIV, same thing at 17.1. And I do have to say that I have an upcoming, and I got some really great Q&As coming up, guys. Really long, in-depth Q&As, and I got one with Hamilton ETFs where I talked to Nick Picard over an hour exclusive Q&A with Nick Picard, and we're going to talk all about Hamilton's option strategy. What kind of options do they write on stocks, on indexes, their distribution policy? Why do HMAX and UMAX and SMAX, their yield maximizer ETFs, which has been expanding. Why do they have variable distributions? How do they decide that? What is their take on daily options? All kinds of, we tackle some member questions as well. So pretty excited about that. Make sure you watch it. If you own any Hamilton products, you gotta watch that Hamilton Q&A coming up. Should be coming up in the next week or two. Moving on, of course, we have the Global X, which I'm showing you the leveraged versions, but remember they have unleveraged versions of all of these. These are all diversified and focus on a particular index in a particular geographic area. So you have USCL, S&P 500, Covered Call ETF with 25% leverage. QQCL is the NASDAQ 100 index. CNCL is the TSX 60. QQCL, by the way, about to celebrate its 1-year anniversary. Came out in October. So we'll probably see the yield up here, which is definitely one of the more higher yielding ones in the 13s right now. You guys know I love the NASDAQ 100. Very tech focused. You have EACL, which focuses on EAFE. So Europe, Australasia, I think Australasia, I believe it is, and Far East. So basically developed countries in Europe, Australia, Japan, which I guess is the Far East one. And you have an EMCL, which is emerging markets. And but you guys know, I really prefer either the US focused one or EQCL, which is the whole world. It literally combines these 5 index-based covered call ETFs. EQCL, this is just give me the whole world with covered calls with 25% leverage. So that's EQCL. None of them, as far as I've checked, have any distributions have been steady, have been the same. And we know that Global X tends to have stable distribution. Speaking of Global X, I have a in-depth Q&A with the portfolio manager and head of ETFs at Global X, who used to work at BMO, a long in-depth Q&A as well with Global X, where we dig deep into the options strategy as well. So if you own any of these Global X products like I do, make sure to watch that. That's coming up in the next week or two as well. Moving on to BMAX, this is Brompton's all-in-one. So this one, just like HBIE, has some fixed income, not 60-40, it's about 75-25, doing really, really well. They've already announced distribution increases twice here, start at 10 cents, 10.4, now it's going to be 11.5. So obviously doing really well. Performance has been phenomenal on all of them, by the way, all of these. Obviously that leverage helps. That's why you guys know I love the leveraged funds, which is all the ones we've seen so far, right? So this is Brompton's all-in-ones. So not much to say about that. And speaking of Brompton, well, actually, I'll save it for the later part. I do have a Q&A with Brompton coming up as well, where we discuss split funds in detail, which have been on an absolute rocket ship lately. We're talking 1-year returns of 60, 70%, some crazy, insane returns. And I'll show you that a little later in the video when I cover the Brompton split funds, if you will. So moving on to other diversified funds that are fantastic, that you could buy and hold forever, et cetera, that don't use leverage, right? So obviously, all the Global X ones have unleveraged versions. HDIF, HBIE. I know I don't talk about this often, but they have unleveraged versions. You see that here, HRIF, HBIG. This is my personal opinion. If you're going to buy and hold something forever long term, you might as well, for the income, you might as well have the leverage. The proof is out, right? The leverage one beats the non-leveraged one when the markets go up, which they typically do over time. But anyway, moving on to the non-leveraged options, you got ZWQT, the all-in-one of BMO. So BMO's, it's a collection of BMO's covered call ETF. So that, no leverage here. BMO's a little bit more conservative. So that's why this one probably has the lowest yield here at 6%. And as far as I know, they did not change the distribution. It's still at 8.5 cents per month right now. ESPX, ETSX from Evolve. These have fantastic performance. I do have a Q&A coming up with Evolve to discuss more their new ETF and their technology ETF, their bank ETF, but maybe we'll discuss this one as well with them. So ESPX is literally the S&P 500 with covered calls. ETSX is the TSX 60 with covered calls. So obviously, their competition is clearly for this one is USCC, right from Global X, and CNCC for the TSX 60. And this one has lower yield, 7.5, but they only write covered calls on 33% of the portfolio. So this one has been doing really well because it's been capturing a lot of the growth of the S&P 500. That's what happens when you write less covered calls. You get more growth if the markets go up, but of course you get less yield. So these ones are doing really well as well. I am expecting, I have a strong suspicion that the distribution is going to increase. Maybe they're waiting for the next year. I think they could probably increase this a little bit because it's done so well. Volatility is pretty low though. However, ETSX here at 9% yield, and this one also has not changed their distribution, still at 16 cents here. Next we have PDIV. So I don't usually include this one, but I got to include it because this episode is, this monthly series, I want to cover the whole income covered call landscape, focus on diversified funds. I'm going to be adding more and more funds because some of them I've excluded. So PDIV I added back. I'm going to add to the list here. It's very unique that it's about 50% Canada, 50% US. So this is non-leveraged. It's pretty big in terms of AUM for a more niche Canadian fund. Management fees, your typical 65. Very high yield. I was surprised by that. And if you look at the portfolio breakdown, you can see it's about half US, half Canada here. And you got, big cap stocks with covered calls and even some puts in here, covered puts as well. I think that these guys could do covered calls and puts, but it says emphasizes Canadian stocks with complementary US exposure, but US exposure's higher right now, which I like because, US is king. So this is kind of a hybrid, another one to consider for sure. And of course, we have a giant in the covered call space in the US, JP Morgan, that manages JEPI and JEPQ. Those are still the biggest covered call ETFs on the US market. And guess what? They have launched JEPI and JEPQ on the Canadian market, on the TSX, with the exact same stock symbols. The problem is I can't find their official website in Canada or their official web pages for JEPI and JEPQ. I've reached out to them. I haven't gotten a response yet. So when hopefully they do get the pages. I think they should and they will. I'll show you that. But I'm expecting that JEPI and JEPQ will simply be clones of the JEPI and JEPQ in the US, except you could buy them and sell them in Canadian dollars. So if you love JEPI and JEPQ, you love that defensive nature of JEPI and JEPQ. Remember, they're not exactly the S&P 500, not exactly the NASDAQ 100, or they stock pick within those, and they do out of the money calls. So the yield is lower, but definitely has a little bit more defense. And, people just love the massive power of JP Morgan and what it brings. That's why people are comfortable investing in companies like JP Morgan, BlackRock, iShares, which is BlackRock. Like and subscribe. And Vanguard. So another giant joins the fray, the covered call party. Actually, a couple, even Invesco. Is Fidelity. So Fidelity has launched the Fidelity Equity Premium Yield ETF, which is and it's called FEPI. It's basically trying to compete with JEPI. What's interesting about this one, management fees lower. I think JEPI and JEPQ, I don't know what the management fees are in Canada. In the US, they're 35. I'm assuming they'll be 35 in Canada, but I don't know. Management fees a little bit higher at 40, but than JEPI and JEPQ, but lower than your average covered call ETF. This one has no leverage. What I like about this one is that it's the S&P 500, 2% out of the money. So it's kind of like IVVW in the US, which is S&P, which is the BlackRock one, the lowest fee covered call ETF ever. It's the S&P 500, 1% out of the money. This is 2% out of the money. So obviously less distribution, less yield than that one, but you're capturing more upside. So you're basically giving up 2%, past 2% upside of the S&P 500 every single month. So this is a good one, I guess, to consider if you really want to invest in something that does a rinse and repeat strategy. You know what's going to happen. You're basically investing in the S&P 500, and they're writing 2% out of the money call. So you're basically giving up the upside if the S&P 500 goes up 2.1%, you're giving a 0.1% that month. It's not rocket science, right? I don't even think, did they declare their first distribution? I don't think so. This one just came out in September, guys, a couple of weeks ago. So there's no distribution yet. But I'm assuming it's going to be on the lower range. It should be about half of the distributions or lower than IVVW, which is about, I think, on average, 12 to 15%. So I wouldn't be my estimate is that this one's going to be about 8% yield, something like that. Invesco, the guys who manage QQQ, the very popular NASDAQ 100, QQQ is kind of like the equivalent of SPY, right? The original index fund for the NASDAQ 100. So I guess I should have showed this one. So they have QQCI. This is the Invesco NASDAQ 100 Income Advantage ETF. It's basically covered calls on the NASDAQ 100. So QQCC actually has some competition now. So they were, it was pretty QQCC, QQCL, the only NASDAQ 100 covered call ETF pretty much. But now Invesco, I can't think of a better manager than Invesco to launch it, however, because they manage QQQ. So in Canada, we have QQCI. They did declare their first distribution, I believe. Management fees really low. It's actually 0 as a promotion till the end of the year. Then it goes to 34 basis points, right? QQCC, I'm just curious. QQC, I believe it's 65. It's 65 basis points. So yeah, a lot lower fee. So QQCC is definitely going to have to watch out. They have competition. I haven't compared them yet, but it's very early because this one is new. But first distribution at 16.8 cents, and I calculated it. If you do 16.8 times 12 divided by the current price of 20.84 times 100, it's about 9.67% yield. So that's pretty much in line. It's slightly less than QQCC. So they probably do a bit less call. So this is probably going to capture a little bit more upside of the NASDAQ 100. So we'll follow it closely. And then you have EQLI, which is S&P 500, but equal weight, not market cap weight. So this is a little twist on it. This one, I think the first distribution's out, 15. It's about 8% yield, something like that. I don't personally understand why someone would want the S&P 500 equal weight, but it turns out this is actually, it's only been a month or two that it's been out, guys, but it's actually beating the regular S&P 500. And I think I know why, because the S&P 500, market cap weighted obviously has more focus on the technology stocks. Equal weight means that you'll have more exposure to the financials and more cyclical sectors that are impacted positively when rates go down. So I think that's probably what happened. But if you look at a 10-year, 15-year, 20-year chart of S&P 500 regular market cap weighted versus equal weight, the regular one wins every time. So anyway, I guess it's a little twist on the S&P 500 one. I guess you could compare this one to USCC and ESPX would be, I guess it's kind of competitor because those ones are market cap. This one is not, but still the S&P 500. So that is pretty much it for the diversified landscape, everyone. Let's check out the crypto real quick and closed-end funds and split funds. So in terms of crypto, you have BTCY, ETHY, this one for Bitcoin and ETHY for Ether. Ether has been lagging a little bit. Bitcoin's been okay. It's been flat. Not that much action on it. Distributions have not changed for a while for both of these. I was expecting the Ethereum one to cut it, but they didn't yet. The yield is really, really high now at 15. I have a strong suspicion they're going to reduce it. Bitcoin, it's a pretty solid 10% yield, something like that. Still, 1038. Sorry, I'm moving the screen faster. Split funds. Let's go through split funds. I got an in-depth Q&A coming with Brompton to try to figure out why these split funds have been on absolute fire in the last year. We're talking like 60%, 70% returns on a lot of these. It's not rocket science. It's the leverage. Really, really helps. But one thing I do want to point out, and we pointed out in the video, is that many split funds are on sale. They're actually discounted to NAV, including my personal favorite one, GDV, right? You can pick some up at 1087. The net asset value is higher, 1141. So you're getting a 3-4-5% discount with GDV, which is very, very diversified. DGS, not on a discount, but pretty close on par, right? 646 is the NAV, 681 you pick it up for. LBS trading at a small discount, right? You could see that the stock price is lower than the NAV. That's a discount. LCS still at a discount. Stock price is lower than the NAV. PWI at a big discount, 917, but it's worth 1029. This has been one of the highest performers of the last year. SBC trading at a small discount as well. It's worth 997. You could pick some up at 987. So why are they trading at discounts? Why have they gone up so fast in the last year? We talk all about it with Michelle and Chris in a dual Q&A. Middle field, you got their split funds here. Here they are. Sorry about that. ENS trading at a pretty big discount. You buy it for $12.50 about. It's worth $13.62. So Enbridge is a pipeline. Interest rates going down helps. And the NAV has gone up and up and up, but the stock price hasn't kept up. So ENS at a discount. IS at a massive discount. This is the newer one that focuses on infrastructure stocks. A lot of utilities in there. 15.16, but it's worth 17.44. And RS, unfortunately, now has gone down. You know, REITs have taken a little hit the last week or two. Why? I don't know. Maybe profit taking. Who knows? But this one is actually is trading at a premium, and you pick some up at 12.79. But the NAV is not that far off, maybe at a 5-6% premium at 11.93. So very interesting time for split share funds. Many are trading at discounts, including the very popular and legendary EIT is trading at a discount. It's almost going to hit $15. So I'm really wondering if they're going to keep the distribution 10 cents forever, because now the yield is somewhere in the nines, right? Or even less than that. What's 1.2 divided by 1479? So on 1479, the yield is 8. Wow, it's 8% yield. So, you know, they should raise the distribution to at least 11 cents or something like that. Anyway, we'll see what they do. You do have DFN, FTN, I believe, also have been going up and up and are trading at small discounts. It's harder to tell because they don't update their stuff often. So NAV 617, and I believe DFN is trading a bit lower than that, which means that DFN is actually at a discount. Same thing for FTN, 866. I think FTN is slightly lower than that. So this is a general thing that's happening now. Split funds have, their net asset values, their intrinsic values all have shot up. Market price has not kept up. So it's a good opportunity for investors who want to capitalize on those discounts. So that's it pretty much for the overview, the income landscape. What's undervalued? Is there any sectors that are undervalued? It's really hard to tell. It's really hard in a record high market. I think utilities are still undervalued, and I really like the new Evolve UTES Utilities Fund, which focuses on telecom, pipelines, and utilities, electricity generators. So it's a nice little mix here, because utilities tend to borrow a lot of money. So when interest rates go down, which is what's been happening, it tends to help them. Especially the telecom. The telecom ones are really taking the beating. Bell Canada is really low. It's like at an 8% dividend right now, which is incredible. Are they going to cut the distribution? I don't know. But if you want something that's a bit safer than picking Bell Canada or TELUS, you could take this one. This is probably the one I own and my favorite one because it has leverage. You guys know that that's just my favorite style of investing. I would always take leverage. But there's other ones. There's ZWU, there's HUTL, there's UMAX, there's HUTS, which is non-covered calls. You have the leverage version, of course, of HUTL, which is HUTE. So HUTE, if you want utilities, and UTES from Evolve are really pretty much the only leveraged ones. Well, that's not true. You actually have HUTS, which is leveraged, but there's no covered call. So, quite a few utilities ETFs to choose from. I think REITs are still undervalued as well. So of course there's RS. You guys know that's my go-to. There's no covered calls on RS. It's pure growth, and there's a lot of leverage there. So if REITs start, keep going up and up and up, or explode because investors start realizing, okay, well, interest rates going down really helps REITs, RS is going to pop. But there's MREL as well. If you just want the ETF, now we have RMAX, which is very, growing rapidly. RMAX is a covered call REIT ETF that has half Canada, half US. Harvest also has one called HGR, which is focuses on REITs outside of Canada. So you got some options there. And of course, if you're into fixed income, I'm not really into it. You got, bond covered call ETFs, and the list is large. You got Happy Tea from Harvest, and these could benefit when rates go down. You also have the medium term one, HPYM. Hamilton has H bond, and a shorter one, short duration one called H bill. Evolve has bond. They even launched a new one called AGG, which is a collection of bonds with covered calls. So you got quite a bit of options. Global X has MPay, SPay, and LPay. So you got a lot of options there. If you want to pick up some fixed income, if you feel that U.S. government bonds are going to start going up now that the Fed started cutting rates. So that is pretty much it, everyone, for the income landscape in Canada. The U.S. episode, covering the stocks on the U.S. market should be out in the next couple of days, and we're going to do this again next month. Don't forget to like and subscribe. This is your number one source. Will always be your number one source for income-oriented investing. See you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades, and PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.